Welcome back to the long game. My name is Franco.
And I'm Jarrod.
Today's episode is all about our latest research reports. We'll be giving you guys a research rundown on China Bank and KEEPR. So let's just start right away. So Jarrod, why don't you walk us through your report on China Bank?
Okay, so my latest report was on China Bank, CBC, and the title is At the Sweet Spot of Value, Quality, and Yield.
Wow, why is that?
So you'll find out later. So let's look at some of the key points first. So let's start with loan growth. So what I like about CBC is the steady loan growth. So if you notice, loan growth will sort of moderate in the coming years, but I think that's mainly because it's coming from a high base,
Right.
coming from the
Post-pandemic.
right? So of course, once you had the pandemic, suddenly loan growth was growing double digits every year. So now that it's already post-pandemic, I think it's going to moderate a bit. So a little bit high single digits. So I don't expect double digit loan growth moving forward.
But I see here that consumer lending will be driving most of the growth.
Yep. So consumer lending will pick up. So there's been a shift towards more higher yielding consumer lending. But of course, the backbone of loan growth will still come from corporate loans, which which accounts for around 75%.
Yeah, most of it, yes, from corporate commercial.
Yep. So if you also notice in 2027, right,
Yeah.
there's sort of a pickup in loan growth. So that's because I assume 125 bips rate cut this month.
Yeah. And then
Before the
also
end of the
more
year,
next
yes.
year.
Then 225 bips rate cuts next year. So the pickup in loan growth in
It's
2027,
mostly because of lower interest rates.
it's just the lagged effect of the cheaper cost of lending, right?
Yeah.
So I expect a bit of a bump in loan growth for that time. Then one big factor that I will be watching is GDP. So especially if GDP continues to miss estimates, right? Due to corruption and I guess weaker infra spending and all those.
And I guess some weather-related disruptions in the
Yeah.
second half of this year.
So if GDP misses by a lot, then it's only natural that analysts, not just me, like everyone else, will lower their loan growth estimates. So that's something that we are watching out for.
Yeah.
But in general, I think CBC will maintain mid-high single digit loan growth.
Compared to the other banks, though, how are they in terms of like consumer lending? Do they have more than the average, or are they just in line?
Yeah, so I'm projecting around 17%. So that's pretty high, to be honest. Like within the top three banks, I think they're growing at a little bit lesser. Like
Lower teens.
yeah, lower
Like
teens.
less, actually, like double digits, but
Yeah.
not in the high teens.
This one is mid higher teens.
Yeah.
So I think consumer lending is very strong for
I mean, they
CBC.
need to offset the effect of lower rates on their net interest margin. So,
Yeah.
yeah, that's the way to go. Consumer lending, high risk.
Yeah. So yeah, I think generally, yeah, this is what we're looking at. Next is I want to highlight, like what you already pointed out, was the increasing consumer mix. So this year I project around 75 to 25% mix. So this 75, this is the corporate loans, the business loans. Then this black, the 25, is the consumer loans. So what management told me is that their medium term target is around
What,
28% in
Oh.
consumer loans.
Okay.
But in around 5 years, they want to see a 70-30 mix between corporate and consumer.
Okay, yeah, I think that can happen. Looking at your trajectory right now,
Yep. So what I did was I just estimated,
it's like a 2% increase every year.
yeah, so I just see parang small bump in the consumer share
Yeah.
each year. So in 5 years, that should be
And
closer to
I suppose with
70-30.
lower interest rates, it should pick up because it's cheaper now to borrow.
Yes. And I'm also thinking about there's just more awareness on taking on loans right now. Like there are a lot of people are being more financially literate, right?
Would you say that the consumer loans are mostly like personal, housing, auto,
I think a lot of auto credit cards,
credit card?
housing also.
Yeah.
So I think it's a fair mix of those. So yeah. And another reason why they're increasing their consumer mix is like what you said, the BSP is in a rate cut regime. So when interest rates are going down, you need something to offset the compression on your margins, right?
Yeah.
So consumer loans are higher yielding, right? Of course, they're a bit more riskier, but they're higher yielding and they're able to offset, right, the potential margin loss from that. So yeah, I think generally not just China Bank. I think for
All the
all the
banks.
banks, right? Like you cover BDO, Metrobank, BPI.
Yeah.
They're all shifting more towards
Yeah,
consumer.
especially BPI. BPI is really leaning towards a consumer mix. And then
Yep.
BDO and Metrobank, not as much, but they are.
Yep. So it really depends on that. But generally, that's the trend for the whole banking sector.
Yeah.
So, and as long as rate cuts, the trajectory is going down, which I think it will last a bit longer. I think there are some people estimating 325 bips rate cuts next year instead of 2 because of the weaker than expected
Yeah, they're
GDP.
going to have to boost the economy if GDP keeps lagging.
Yeah, but for my research report, I only assume 2 next year just to be conservative, right?
Mm-hmm.
So let's look at the next kicker for China Bank, and it's about profitability. Did you know that they have the highest ROE
ROE.
among the top 4 banks, right? So right now it's sitting at above 15. I mean 15.02, right? And that's excellent, right?
Mm-hmm.
Among the bigger cap banking stocks. I think the biggest ROE I saw within the whole banking sector is actually AUB. I think it was at 21 last I checked.
Wow, that's pretty
Yeah, that's
high.
crazy, right? 21. But AUB is a smaller bank, right? So it's not really comparable. But when you compare it amongst the
Yeah,
top
but-
4 banks,
Yeah.
it gives you a better picture, right?
I mean, although AUB had a crazy run until their 100% stock div.
Yeah. So there. So this is why I generally, in terms of if I were to pick one bank, right, then just looking at this, I would pick China Bank. Then let's talk about margins, right? NIM.
Yeah, a very important factor among the banks.
It also has the highest NIM, not just the highest ROE, but the highest NIM.
So, wow,
NIM
among the four.
Yeah, NIM means net interest margin. It's basically like your profit margin, but for the bank. Right?
Yeah,
So I project
it's kind of flattish.
generally flattish to declining net interest margin trend. But management did say that they expect a 5 basis point improvement in NIM for every 25 basis point rate cut. That's their guidance. But of course, I want to be a bit more conservative. So I still projected a slightly decrease every year, but generally stable.
Yeah,
So there.
here Metrobank has the lowest.
Yeah. So
Mostly because it's more conservative.
yeah. So if I were to put it on a scale, I think China Bank is like the second most conservative. I don't know if you would agree with that.
I don't know.
But for me, based on how I was looking at it, I think China Bank is the second most conservative among the top 4. So of course that's a subjective, but
Yeah,
for sure Metrobank's the most conservative.
I know the most aggressive one, Union Bank.
Yeah, because their consumer portfolio
It's
is
most
it's majority
of their portfolio.
So there, I think at this time where we're in a rate cut cycle, it's very important that NIM stays stable, right? Which I project China Bank to do so, right? So that's one plus point for China Bank. Then what else? Oh, this is my favorite part. So I don't think a lot of people have been talking about this specific point for China Bank. So China Bank, if you notice their deposits, time deposits make up over 50% of total deposits. So here green this green line, this green box, that is time deposits. Then the black one is demand deposits or like your checking accounts, right?
Yeah.
Then the gray is your savings accounts, which earn you 0.0625, if I'm not mistaken. So from here, what I can say is that the deposits are kind of higher. They cost a lot more because there's more weight on the time deposits, right? Because time deposits right now they yield you around 3 to 4%,
Yeah,
right?
they have a high interest rate.
Yeah, so you can from this you can see that the interest that China Bank has to pay to its depositors are higher than ideal, right? So I think with other banks, later I'll show you a graph. The other banks, less than 50%, is their time deposits. Time deposits is less than half. That's why their funding cost is way lower.
Yeah, on the next slide, right?
Yeah, but here, generally, this is what I see. Next, let's talk about the funding costs. So, given that 55% of total deposits are in time deposits, their funding costs are higher than ideal, right? So, if time deposits as a share of total deposits decline, right? Or that's what you call CASA, right?
Yeah.
CASA is basically your demand deposits and your savings, right? So if time deposits go down and CASA goes up, your funding costs will be lower because you're paying less interest to your depositors, right? So here we can see that generally I think the asset yield of China Bank will be pretty good, stable. So it will increase in 2025 to around 6.82%.
Yeah.
Then it will sort of decline because of the interest rate cuts, right?
But it's still kind of on the same level.
Yeah. And despite 55% of deposits being time deposits, their funding cost is actually not that high.
2%.
Yeah, like if you compare with the other banks, they're around 2% rin, diba? So imagine how much lower that would be if
They had more.
if CASA improves.
Yeah, if they have less time deposits. But though a lot of people use time deposits because of the interest rates.
Yes, exactly. But I think China Bank management has targeted the plan to hit 50% CASA ratio, which is basically 50% time deposits. The remaining 50% is in demand and savings.
I wonder how they're going to do that.
Yeah, so that's what they said. But of course, I cannot
I feel
project
like
that, right?
one of the easier ways is just to increase the interest rate on regular savings.
Which I don't think they will. Right?
It's already so low. It's
Yeah.
like less. It's like what?
0.0625.
Yeah, that's unfair. That's unfair.
Yeah, exactly. Versus the digital banks. no?
Yeah, that's why the digital banks are. I wouldn't be surprised if they end up having more deposits in the
Yeah,
future.
exactly.
Maya 3.5%.
Yep. So, but here I want to point out the opportunity. If they do hit 50% CASA, imagine funding costs will be way lower. And the net interest margin, as a result, basically, it's like you compute the interest spread, right? The asset yield minus, if asset yield stays stable, funding costs go lower, the interest spread will be higher and your net interest margin would be higher too, right?
Yeah.
So there. Next, this is my favorite slide. So
The CASA.
This is the CASA of all the top 4 banks. And you can see that China Bank is clearly the loser here. It's
Lowest.
lagging behind the rest. So look at actually BDO, wow. 70%.
Maybe it just shows that China Bank has better time deposits.
Yeah, maybe it's higher, right? And yeah, that means for BDO, time deposits are only 29% of total deposits.
Mostly savings.
Yeah, most are in low cost deposits, right?
Yeah.
Which are your checking and your savings accounts. But like what I said, management does aim to do 50% CASA next year. But of course, for me, like coming from 44.6, you wanna bump it up to 50 in 1 year. That's kind of aggressive. That's why I just projected, incremental.
45.
Around it stays at
46.
around 44.6 to 46, right?
Yeah.
So I'll have to see in the next quarters if there's really momentum in bringing the CASA near 50. So I don't wanna just I'm not the type who will just whatever management tells me, that's what I'll do, right? Of course, I use my intuition, Rin. Like, is it really possible within 1 year, right?
What if they do it though? What if they're able to
Then
bump
that
it up
would
to
be
50?
good. That would be an upgrade, most likely in our target price.
Okay.
So there. Next, asset quality. So China Bank has the second lowest gross NPL. NPL meaning non-performing loans among the top 4 banks. So it's actually
It went way below.
it's
It dropped big time in 2024.
So really the asset quality has been outstanding. And it's just behind Metro Bank, which of course is the most conservative bank.
Yeah. But most of them have been slowly increasing their provisions because everyone is slowly getting into consumers.
Yes. So later I'll show you. We also have a slide for the provisions, but generally I think asset quality will still be good. I do expect a bit of an uptick, but very small because of course when you're shifting the loan mix more to consumer, of course you'll have a bit more defaults, right? That's why I project NPL to slightly increase over time. But it's nothing crazy. It's still below 2%. That's so low, right? So there, good asset quality. Next, capital adequacy. So CET1 ratio, total capital adequacy, and equity to assets. I think they will remain solid. So they're all trending up. And they're still above their regulatory requirement.
Yeah.
So I think
all the banks are. I mean, obviously they have to be.
you have to be. And I think
It depends on how big the buffer is.
Yeah, so I think the buffer is still substantial for China Bank. And here's the third quarter results. So all you need to know is here, net interest income up 15.2%. So did you know that this is actually the 25th straight quarter of net interest income growth quarter on quarter?
Wow.
25th straight. That's crazy.
That's a lot.
Yeah.
Why are they trading at such low valuations?
Yeah, exactly, right. So there,
I guess there's more to it.
So every quarter for the past 25 quarters, they have been growing.
I can see loan provisions grew nearly 400%.
Yep. And next, what I want you to see is here, loan loss provisions. So they went up almost 367%. So this is like what Franco said, because of the shift to consumer, your loan loss provisioning will see an uptick.
Yeah.
But this is coming from a low base. So back in 2022, the loan loss provision was 9 billion.
9 billion or 9
9 billion.
Oh, 9 million.
So right now it's at 7 billion. So it's more of like going back to the mean, right? Normalization. So nothing crazy. But look, even with the rise in loan loss provision, your net income still went up 10%. Despite a huge increase in loan loss provision. So, wow, right? Like, let's say they kept loan loss provision flat. then
That would have been huge.
you would have been up what to more than 20%, right?
Yeah. Another 5 billion.
Yeah, diba? So really, I think China Bank, even with higher provisions, I think they're still growing
Yeah.
very well. So yeah, next. Okay, then why is the title at the sweet spot of value, quality, and yield? If you look at the PE, China Bank is the cheapest among the group. If you look at price to book, China Bank's also the cheapest. If you look at ROE and NIM, right, like what I pointed out earlier, it's the highest among the top four. So the cheapest.
It's very close to Metrobank though in
Yeah,
the
best
price
quality,
to book.
best quality. The yield, it's not better
It
than
can't beat Metrobank.
it's
with their
not better than
special.
Metrobank, but it's higher than the average.
Yeah.
But here you have to think about this. Are you willing to give up a bit of the dividend yield for better ROE and NIM? Because look at Metrobank's ROE and NIM. They're inferior versus the rest, right? So parang
Lower, yeah.
how I view Metrobank is you have a higher yield, but that's only to compensate for the lower ROE and NIM. But if you look at China Bank, it's really at the sweet spot. It's the cheapest, the best quality. The yield is better than the rest, better than the average.
Yeah.
So that's why I called it at the sweet spot of value, quality, and yield, right? And if you look at the China Bank's own historical average, you might think that it's a bit pricey, right? Based on its historical average.
But it's not.
I think it's okay because
It's slightly cheaper than the historical average. Slightly.
yeah,
cheaper.
slightly. But generally, I think the operational performance of China Bank has been improving. So I think it warrants multiples expansion, right?
All I want to know is, will it give higher dividends?
Okay,
Can it give higher dividends?
That's our next slide. So yes, so here we project net income to still grow. So this year around 9%, next year
13.
13.
Picks up 2026.
Then 2027 coming from a high base around 6%.
Okay.
And dividends accordingly will grow. So this year they already gave 2.5. So next year we expect 2.72. Then 2027 3.08.
Yeah, hopefully they increase it.
Yeah. And another thing, so their dividend policy is max 30%. Right now they're only paying 27.13.
So there's 3% left on the table.
So if they maximize that, then we might see dividends go up much more.
Yeah. Oh yeah, so based on this, I think based on the historical trend, I think we can expect higher dividends.
Yep. So yeah, that's it.
And I guess this is one of the reasons why it's part of the D15.
Yeah. So it's really
Dividend growth. I'm really just after the dividend growth.
if you ask me what's my top banking pick, it's China Bank.
China Bank.
And
And then I guess in the next slide we can also talk about why it's also unfortunate because prior to the huge run up, it was a candidate for PSEI inclusion, and obviously because of that, a lot of people got in. And then on the rebalancing date, because of liquidity,
yeah,
they
bought here
they bumped it up 40%,
30%.
30% at the runoff. So obviously, all the fund managers or index trackers are now in the red
Yeah,
for this
so-
position.
All the fund managers, they're here. They're stuck here.
Yeah.
Unfortunately. So, but now price has already corrected from that huge liquidity event.
This is so I think the run up and the downtrend has all been caused by speculation about its membership in the PSEI.
Yes.
Because the run up, it's part, right?
Yeah.
Because it was going to join. And then the decline is because the proposed PSEI rule change of the 15% float for a minimum cap of 120 billion would put AP in and kick CBC out.
I think no, CBC's out because of the liquidity.
Okay, yeah, liquidity.
Not the float.
But still, with the changes, it gets kicked out.
Yeah. So that's one thing that we're looking out for. So will CBC get removed or will it retain its spot
It
in the
needs to
PSEI?
trade a lot more
Yeah.
until there are only a few trading days left before
The
the Jan to
cutoff.
December period
The
is
cutoff
done.
is December 31, right?
Yeah, so
The end of the
The
trading.
Feb 2026 rebalancing, it covers the period from January to December.
Okay, so
So it has a few more, like a full week left
Yep.
in terms of trading days.
So I think China Bank, of course, there's that speculation part on the index membership. But if we're talking about fundamentals only, there's no problem with China Bank. It's great. And looking at the chart, I think my buy below is 53, so that's the resistance level right here. I think as long as it's trading around between the support at around 48 and 53, I think you can start accumulating na a bit.
Yes,
And
I mean, so far the market has been driven by sentiment rather than fundamental concerns.
Yeah.
So.
And the good thing is it's also part of Para, right?
Oh yeah,
It's a Para stock.
it is a Paris.
So if we go back, you see this gross dividend yield. That's basically your net dividend yield. So next year you're getting around 5.22%.
Yeah, if
For a
Jarrod's
bank.
estimates are right, yeah.
That's pretty good. na.
So if you guys are building your pair portfolio, definitely add CBC to your watch list.
Yep. So just to wrap it up, China Bank, it's at the sweet spot of value, quality, and yield.
So
I
it's
have a buy
buy.
rating. My target is 65.05. Buy below 53.
So right now, China Bank. Let's do a quick check on China Bank. So as of December 2, 11:04 a.m., China Bank is trading at 51 and 20 cents. So below your buy below. So it's buyable right now.
Yes, you can buy it right now.
Yeah. All right.
So-
Hopefully it reverses.
Yep. Okay, so what do we have next?
So next is my topic for consumer growth.
Wow. Okay.
So it is
consumer.
the Keepers Holdings. So if you guys like alcohol, pay attention. Because you will definitely know the brands it distributes. Because they are actually, I think, one of the best distributors in the Philippines because of their portfolio of brands.
Okay.
We'll get into that. So Keeper, I like it for a very simple reason. Keeper is a structurally advantaged distributor riding three powerful tailwinds. So one, obviously, it's part of the Costco group. So it has synergies between Pure Gold and SNR.
Yeah, that's owned by Lucia Ko.
Yeah, exactly, right? And then we have the rising consumer spending or improving consumer spending, the ongoing premiumization on the liquor market. So those are the three reasons. And then for growth, I think what I'm excited about is the expansion into its own retail outlets.
Ooh,
So
okay.
right now, Keeper is purely distributor here in the Philippines.
Yes.
It's just distributing here in the Philippines. But it has plans now to open its own retail chain. So it will have its own specialty wine and spirits
So
store.
it's a wine shop.
It will have its own wine shop. Do you know
Oh.
Wine Cellar? There's
No.
because if you go to Estancia, if you go to Unimart, there's like a store there called Wine Cellar. It just sells alcohol. That's it. So I'm guessing it's something like
So
that.
they're gonna do that same concept.
Something like that. That's
Okay.
because so far I'll get into it later, but so far there hasn't been a lot of details on their
Okay.
expansion. But let's start with double-digit growth and attractive margin. So based on their earnings and projections, or my projections, so a lot of the growth is anchored on consumer spending. Obviously, because it's alcohol, it's this consumer. It's a discretionary product, so. So it benefits especially from household spending. So if the economy is expanding, if disposable income is growing, then obviously Keeper will benefit. So you are showing. We'll just
Oh my
Yes,
God.
for a second you were showing your background image.
Oh, okay.
Okay.
Oh, that's weird.
Yeah. So one of the macro tailwinds is household consumption, right? So according to some forecasts from BMI, the real household spending is expected to increase by 5.3% this year versus 5% last year, and then it will further rise to 6%, about 6% in 2026. And with easing inflation and hopefully a stable market, a labor market, then that will definitely support demand for alcohol.
and the growth rate is faster. It's better than inflation.
Yeah,
Right?
and it's fast. Then household spending is also faster than GDP growth currently.
Yeah, right now. Because we
Yeah,
missed,
yeah,
right?
because we missed.
But
Yeah,
if we didn't miss, it would be lower. A bit.
yeah. So
Okay.
yeah, because yeah, they move in correlation. So discretionary. It really depends on discretionary spending. But given that we're in Christmas, we're in the holiday season, there's always a pickup on the last quarter of the year.
Yeah,
So
so you're giving gifts, right? A
yeah,
lot of people give like
alcohol,
wines, right?
wine, right? So or those gift baskets always have like a bottle of wine or a
Yeah.
bottle of alcohol. So uh, there's always an uplift in the fourth quarter
But
of the
that's
year.
mostly just seasonality.
That's seasonality. Yeah, I'll give you the seasonality. So if you've noticed also that in 2022, net sales grew by nearly 27%. So that's really mostly driven by pent up demand from the pandemic. So this is the recovery from the pandemic, and so far it will, and I expect it will moderate until 2026 and maybe into 2027 with low double digit, low teen growth.
So you still expect
Yeah,
double
for
digit.
sure. I think there's still going to be double digit
Okay.
growth in 2025 and 2026. It's also backed by or supported by the premiumization trend that's happening here in the Philippines. So there is a shift to higher priced liquor, according to the International Wine and Spirits Research. Basically, the leader in providing data on the alcohol industry in the world. They're thinking that they believe that this trend is going to be a key driver among all these alcohol brands distributors.
So you really think so if you were to categorize Keeper, it's mostly a growth company, not a mature one yet.
It's not mature. It's definitely not yet mature. I think it's still a growth company, especially with their plans to acquire more brands and expand into retail. It's definitely a growth company. Yeah, but so based on outlook, management has guided low teen top line growth, which actually before I inquired about their guidance was already kind of in line with what I was expecting. Because earlier I was expecting about 13 to 14% income growth for 2025. So for that, net sales would have to increase by about 14% for 2025. Margins would stay stable at about 19%. Yeah. And later I'll show you that they are actually one of the better or more profitable alcohol companies here in the Philippines, publicly listed in the Philippines. Yeah.
Okay.
But before that, let's talk about its category or volume mix.
Okay.
So Keeper, to no surprise, is obviously heavily skewed towards the brandy segment because of Alfonso. So Alfonso is their top brand. Their biggest sales contributor is Alfonso.
For a non-drinker, how would you classify like here? What's a brandy and what's a non-brandy?
So brandy is basically Alfonso. Non-brandy would be your wine, your whiskey, your vodka, your basically anything else.
Okay.
And I don't. So, have you ever tried brandy?
I don't think so.
Okay, so brandy kind of tastes. For me, it tastes pretty good. It's kind of smooth, although not as smooth as like whiskey or scotch, but it's weaker on the weaker side.
Oh, okay.
Because you have really strong alcohol like whiskey and scotch, which we'll talk about the brands in later. You have vodka also. Alfonso's, I would say, good for the like if you're for going for that middle level of alcohol. So you don't really want too strong. You don't want too weak. So, but brandy is a good mix for a lot of drinks also.
Okay.
So for you guys who don't know, Jarrod does not really drink that
Nah,
much.
I just tikim lang. Sip then if I don't like it.
Yeah.
Uh,
Okay, so in 2024, brandy sales have contributed about 76%, nearly 77%, with the remaining non-brandy contributing 23%. Because although it is their biggest contributor right now, it doesn't mean it's going to stop growing. Management believes that brandy will continue to increase its share in terms of sales and volume.
So are we expecting around an 80-20 mix?
Yes. For sales volume so for sales volume, yes. Sales value rather. Eventually, I'm pretty sure it's going to hit an 80-20 mix. I mean, it's almost there by 2026. For sales volume, it's already more than 80-20. But I think with their future acquisitions, I feel like the non-brandy might gain a bit more, especially if they're not acquiring any brandy brands. That's weird to say. Brandy alcohol brands in the brandy segment.
But between the brandy and non-brandy, which do you think has, when you sell it, it has the higher margin?
Oh, definitely the non-brandy has
Non-brandy.
will have a higher margin. Because
Oh,
brandy is priced it's not as expensive, because in the non-brandy segment you do have more premium brands like Johnny Walker, Singleton, Glenlivet.
So the brandy is more of pangmasa.
I
you
would
would
say it's
say
closer there.
Closer. Okay.
Yeah.
Then the non-brandy is more of the premium for like those expensive parties.
Yeah, so according to the same IWSR, so brandy does have a lower pricing than the other non-spirit brands. Although there are some non-spirit brands that are cheaper, but most of them are in the more premium side, right? But so far, going back to the premiumization, it is growing in terms of market share. So in 2017, it was about contributing about 23% of the total revenue in the segment. Now in 2025, it's supposed to be about 36% now. So it is growing. So the trend is there, and KEEPR is poised to benefit from it. So what are the key brands of Alfonso? I'll just name them out. Key brands of KEEPR.
Okay.
Can you guess? I already mentioned a few.
Yeah, I only know Alfonso.
Yeah, so there is for all those people who party and drink alcohol, it would be nice to know who distributes your alcohol.
Okay.
So you have Absolute Vodka, you have Jose Cuervo,
Okay, I heard of that.
you have Singleton, you have Glenfiddich, and then you have Johnny Walker, Alfonso, Jägermeister also, if you guys like Jaeger.
I only know Johnny Walker. The rest I don't know.
Yeah, so all their brands are imported. Also, Jinro Soju is from KEEPR's.
Oh, really? I always see
Soju.
that. Yeah, they're in
that's from them
K-dramas.
also. Also, Red Bull actually is under them.
Really?
Yeah,
That's cool. Like, they have the F1 team, right?
yeah. So yeah, all your alcohol, most of the imported alcohol is from them. All right.
Okay.
Next is comparables. So in the next slide here, you'll see I've come up with a comp table for KEEPR against EMI, Emperador, and GSMI. Although, according to their annual report, their main or biggest competitor is still Emperador. Not so much
Yes.
on GSMI. But with EMI, it does, on the table, it does skew it. It does kind of skew the margins and all the other multiples, because
Yeah.
I'm guessing it's because they are trading at a better value, a better premium, considering that they do manufacturing and distribution, and they have a international business. Because KEEPR is just domestic; they have no foreign sales.
Yeah. Also, EMI is listed in the SGX, I
Yeah,
think, Singapore Exchange.
Yeah, so obviously they have a better premium than
Yeah.
KEEPR. But because of that, obviously KEEPR will trade at a steep discount relative to its
Yes.
peers. But if we compare it to GSMI, which is more closely
Yes.
valued, we see that it's almost identical, except that their margins, KEEPR's margins, is a lot better than GSMI.
Better. Like here, 25, 27,
Yeah, so
15, 20.
If we look at the LTM, last 12 months net income margin, we're at 18% or nearly 19%
Yeah.
against GSMI with
12.
12%. And for multiples, it's slightly cheaper. Um, although, so EPS, it's 9.7 times versus GSMI at 11.1 times. Yeah.
But in terms of price to book, that's 2 times versus 3.4.
Yeah.
So would you say that Keeper is cheaper than GSMI
Yes,
right now?
I think it's cheaper, especially later when you look at the technicals. It is cheaper than GSMI, and it is supported by a very light asset model because they're just distributing. GSMI also manufactures in bottles.
But like let's say Keeper does their store concept, then that would probably entail higher costs.
Yes, and we'll get into that. But I'll show you also why I'm not so worried about their capex plans on their
Okay.
retail chains. And they have better growth in terms of dividend because GSMI is supported by special, right?
Yes.
A lot of their GSMI, a lot of their yield comes from the special dividend yield. Without it, it's very low. But for Keeper, they don't distribute special, but the yield is above 4%.
It's a chunky
It's
regular.
a chunky regular dividend. Yeah.
Okay.
So I think also because I think that it's undervalued compared to its peers or trading cheaply is because it's smaller.
Yeah.
It's smaller than the other two, right?
Mm.
And then, although I do believe that there will be a better valuation in the future because, one, as you mentioned, the retail rollout, and then their continued brand acquisitions. Because I don't see GSMI or UMI expanding their portfolio as much.
Yeah, parang they're just okay with their existing
They're
brand.
okay with their existing brands like San Miguel,
Yeah.
right? The beer San Mig Light. Have you ever tried that?
I use it for beer batter fish.
So that's the only alcohol you consume.
But like the alcohol evaporates already.
Yeah, so you barely taste anything.
Yeah.
Okay, so next is about their growth, their expansion into the retail segment.
Okay.
So
wow.
yeah, this one is an AI generated image.
Can you explain this to us?
Okay, so right now, Keeper is distributing its alcohol brands in Pure Gold and SNR and its other 200 distributing partners, including SNR and Pure Gold. But now they're trying to expand. They want growth, so they're going into the retail segment. So they're becoming a retailer now, a distributor and a retailer. I would even be surprised maybe in 10 years, 5 years, they'll become a manufacturing company.
Oh, like GSMI?
Yeah. By acquiring a factory abroad. Definitely not here, I don't think. But yeah, anyway, so Keeper is shifting up the value chain by entering the retail segment. So it does introduce some execution risk because, how well can they pilot their first few stores, right?
Yeah.
And the location is going to be important. And then competition is also important. So this is more for long term than any near term returns. So don't expect like immediate earnings uplift from these stores just yet. So there is rollout uncertainty because when asked, management currently has no detailed expansion plans. They haven't disclosed the exact number of stores, the size, the expenses related to it. So it's still pretty much up in the air there. But we also don't know if the expansion is going to be aggressive. Because if it's aggressive, obviously it's going to increase capex by a lot.
So this strategy of being a retailer, you didn't include it in your model yet?
In the earnings that I was showing, it did not include it because one, it's not going to significantly increase earnings yet, especially, and also I don't know exactly how many stores they plan on putting. But then I did simulate it in a separate sheet in my file, like what would the impact be. So let's have some assumptions first. So obviously the stores will exclusively sell alcohol, their brands only, and it will likely be comparable to a store of 80 to 100 square meters. So think of like a smaller 7-Eleven or
Like a Dali, something like
something
that.
like that. So it's
Okay.
not huge. I don't think it's going to be that huge, especially if they're only selling alcohol,
Yeah.
because the overhead cost will be too much for that. And then I think at the start they might leverage the foot traffic of their existing grocery store network. So they might have stores near a Pure Gold or near an SNR.
But like, what's the point? Because right, they're also selling inside Pure Gold and SNR.
I think for me, I think it's just because they at the start, for it to be successful, they should leverage some synergies. Not necessarily beside the Pure Gold or like a SNR. I'm thinking that's where they might start, although I think it'll be near most of their establishments. But eventually, obviously, if it's successful, they'll obviously expand into untapped regions, areas.
I think in the future, of course, as right now they haven't rolled it out, so it's not
Yeah.
yet a concern. But I think one thing that we should watch out for is the cannibalization, store
Yes, yeah,
cannibalization.
that's really a good point. It's just that we still don't know exactly
yeah,
where
exactly.
it's
So
going to be.
we can't really predict anything,
Yeah.
right? Can't
But obviously,
estimate.
they will have to place their stores in untapped areas.
Yes,
Yeah.
to tap new customers. Right?
I mean, if you look at it now, there are still wine stores beside grocery stores.
Yeah.
Because obviously, they can't sell that in a grocery store because, you know, you have to be 18 years old
There's
to buy. There's
restrictions,
restrictions,
yeah.
age restrictions. So, like the harder liquor, the premium brands would definitely be in its own store.
Okay.
Although SNR is different. SNR you can actually find the nicer premium
Yeah.
brands, but in a Pure Gold you'd find the lower end of the market there. Yeah. So for to illustrate the capex expense of this, so let's say they open 10 stores a year, and following, let's say a small 7-Eleven, that's about maybe 4 million per store. So about 40 million in capex spend for stores alone for just the opening and building of the stores in 2026. But if you follow that up by an expansion of 15 to 25 stores per year, capex will grow to about 100 million annually. So that might sound a lot, but if you look at their cash position, it's very small. So their cash position right now is about 5.7 billion. And so far, if they are opening small retail outlets, that's not going to reach close to 500 million yet.
So you think even with that capex, it will not really strain dividend growth?
Yeah, it's not.
It's not gonna put a dent on it.
It's not really going to put a dent yet.
Okay.
In the first 2 years, I'm assuming it's not going to put a huge dent because one, in the first year, they're only going to test it out. They're only going to open a few stores, and obviously, they're not going to spend ungodly amounts on it. They'll spend about a couple million, couple tens of millions on it, and then if it's successful, they'll slowly start to expand, and that might maybe increase to about 100 million, depending on how many stores they put out.
Okay.
Yeah, so there's really not a lot of clarity. I'm just working on my best estimates based on what I've seen in the in this space, in the small retail space.
Yep. So yeah, because I think the last thing I want to see is Figaro happening all over again, where really there's really cannibalization with
Yeah.
Angel's Pizza. Crazy.
Yeah. So obviously, I don't think that's going to happen for KEEPR.
Yeah.
Yeah, so I don't see any near-term impact on its dividends. So for expectations on earnings, I'm expecting that it will contribute about less than 2% in the early years.
Okay.
Because
that's so small.
yeah, because it takes time to hit mature sales for a store.
Yeah.
Because
Yeah.
I was only projecting the first year about maybe 50 to 70% of mature sales, and then in the next 3 years, that's when they'll hit 100% of their mature sales.
Yeah. Because you have to make a nobody store into a somebody, right?
Right? Yeah. And plus, they're gonna have to spend on marketing, I guess,
Yeah.
and like they
I
have
guess
to make
promo.
sure, promos, a lot of promos.
So
to get-
discounting really,
yeah.
right?
So obviously, it'll take a while before they hit good sales volume and value on their smaller stores.
Yep.
So yeah, small per. Yeah, but the long-term potential on this is huge. I think if they are successful, I think they capture another part of the value of the supply chain or the value chain, and then that would lead to higher margins, and then we start to track same store sales growth. with KEEPR.
SSSG.
Yeah. Yeah.
Okay.
So next is another important factor. It's the synergies with Pure Gold or the Costco group. So this one I'm showing on screen is basically the store count of Pure Gold and SNR in this year and in 2024. So they have consistently grown their stores by a lot. So as of end of June, the first half, they have about 764 total stores. Sorry, that's 666 stores in the first half of 2025 for Pure Gold, and then SNR about 31.
That's like 155 store increase.
Yeah, it's huge.
Wow.
It's really big.
Huge.
Actually, when I checked it for the first time, I was like, is this really true?
155. Wait,
Is this legit?
What's the growth rate of that?
But that's year over year. It's big, right?
Yeah, but year to date, wait, let me check. Wow, wait, 511 minus 666. So that's 155 divided by 511. That's a 30% increase year to date in the number of stores. Wow.
Yeah. That's what I also found hard to believe until I really
Wow.
looked at their reports.
So,
yeah.
so if we analyze this, can we expect 300 stores, 300 new stores end of year?
Maybe. I don't cover Pure Gold.
Yeah.
Maybe.
But
But they're
yeah.
planning to open about 8 more stores
In Pure Gold?
this year. Total.
Then how come the jump in the first half is so big?
No, 8 more. 8 more this after that first half.
Yeah, but it doesn't follow the trend of like 150 in just 2 quarters.
What do you mean?
Like here, the 5112666, that's 150 stores.
Yeah, it's that big.
Then plus 8 na lang.
Plus 8 more.
Why so small?
What do you mean? Why so
Because
small?
for the first half, for 2 quarters, it's 150 stores. Then after that, it's just gonna be 8 stores.
I don't know. It's their. That's what
That's weird.
That's what they announced.
Okay.
Yeah,
Interesting. What's this SNR QSR?
it's their smaller stores. You know where you can get like just SNR pizza or
Yeah.
it's those.
Do
kind
they
of types.
sell liquor there?
No. I'm just including it here.
Okay.
It's the total growth. It's just the
Okay,
total
okay.
growth. Yeah.
Okay.
No,
But
they're not. They don't sell out. I mean,
In the QSR, I got
it's just
surprised.
different. No.
Okay.
I'm just showing the total store count
Sige.
of Pure Gold and SNR.
But really, we should only be concerned with these
SNR
two,
and
right?
Pure Gold.
This one doesn't matter. Right?
That doesn't matter as much because
Because
most
they
of
sell
the
pizza lang eh.
most of the volume is in Pure Gold and the SNR warehouse
Okay.
stores. Yeah, so Pure Gold plus SNR, they contribute about 25% of KEEPR's total sales. So most of it is, they contribute a substantial amount. So every new store that, Pure Gold and SNR opens, it's more shelf space, more visibility, and more sales for KEEPR.
Yeah. And of course, they will prioritize the shelf space for them because it's the same owner,
Yeah,
right?
obviously.
Essentially.
I went to SNR like last week. It's still all their brands, mostly all their brands.
Yep.
Johnny Walker, Secuervo, Absolute Vodka.
Did you see any San Miguel?
Yeah, they still have San
still
Miguel.
have
They
it.
still, obviously, they're still gonna sell it.
Yeah, okay.
Yeah.
But of course, like it's not as seen, right? It doesn't have the better spot than theirs.
I guess.
Yeah.
I mean, I didn't really like take note. Okay, it's here. Okay, then San Miguel is
Yeah.
there, and Heineken's here, and then no, I didn't do that. But yeah. But beyond Pure Gold and SNR, they still have almost 200 distribution partners in total. So that accounts for like bars, restaurants, hotels, other stores,
Like
convenience
7-Eleven.
stores. Yeah.
Yeah.
So if you go to any bar, they have their alcohol probably.
Yeah,
Most
and-
likely, especially Johnny Walker.
Yeah, and
it's
they-
everywhere.
Yeah, they do their mixes, right?
Yeah. Yeah. So it's great having this kind of national coverage because with all their partners, distribution partners, they are basically nationwide.
Yeah. Do they plan to expand abroad?
They haven't disclosed any plans.
But right now they're
to-
only local.
They're only local, but they
Okay.
have investments abroad. Like the manufacturer behind Alfonso, they have a stake in the company.
But that's only on the supply chain
yeah,
side.
it's not. They don't sell it
Okay.
elsewhere.
So,
Yeah.
interesting.
Yeah.
Unlike Emperador, global.
Yeah, they're global.
Oh.
Not Keeper.
Okay.
But the brands are global. It's just that they don't
They don't sell
they don't
abroad.
sell abroad.
Yeah.
Yeah.
Unlike Emperador, they're in Spain.
Yeah.
Right.
Yeah. That's why I guess they're also trading cheaply
Yeah.
because they don't have that
They're only here,
benefit.
eh?
They don't have the benefit of international sales.
Yeah. It's a local expansion story.
Yeah.
Not yet global.
Okay, next is to our outlook on dividend growth.
Yeah. This is what I want.
Because their earnings is still in the double digits and low teens, I still see a trajectory that will support double digit dividend growth over the next 2 years. So for the first dividend, if you guys don't know that Keeper does have a dividend payout of at least 20%. That's the policy. But
Okay.
so far,
That's all low, ah.
yeah, 20%. But so far, they have been distributing 50%, at least 50%
Oh.
of their earnings as dividends.
So
in the last 3
20 is the
years.
minimum.
20 is the minimum. But so
Okay.
far, they have gone above that and paid out 50% last year and then also the year before that.
So
Yeah.
you think they can sustain 50%?
Based on their cash position and their earning growth, yeah, I think they can.
Okay.
So next year in 2026, I'm projecting a 13% growth to about 0.136 in dividends.
What's the forward yield of that?
So the forward yield on this,
Wait, what's the stock price right now? If we're gonna use the 0.136.
well, the last price I used here, it would give you a forward dividend yield of 5.75%.
75. Wow, that's good.
Yeah.
And another thing, this is a para stock. So
This is also a pair stock.
that 5.70 something yield, that's net in your para account.
This is gross. The 5.75 is
Yeah,
gross.
but in para, that's
yeah,
net.
yeah, yeah.
Right? So
Yeah,
it's great.
actually, it's great. It's a high growth dividend stock. So, it's supported by the reason why I think it's easily maintained. It's supported by a strong balance sheet. It has minimal debt. It has barely any capex expense, and it hits retail expansion and earnings growth so far based on like maybe seasonality will support the total dividend per share every year.
Okay,
Yeah.
And I guess I assume it's also free cash flow positive.
Oh yeah, it
And
is.
the cash flows are way higher than the dividends.
Yeah, and for its size, it has a similar cash position to GSMI and Emperador.
Oh, really? Okay.
Yeah,
So they have enough cash pa to like acquire other brands.
they can acquire as much as they want,
Okay,
basically.
that's good.
Yeah, but I still want to point out that dividend growth will moderate because it's still coming from a high base.
Yeah.
Yeah, so don't expect this like 13-14% to last until like 2028, 2029. I think it will get closer to the double digit, but eventually high single digits.
Yep. Because of course you have to understand that nothing will grow like at double digit forever. Of
Forever.
course, there's gonna be like a year na coming from a high base, it's just gonna grow like
Unless
single
you know
digit.
your ICT.
Yeah. And then once it time catches up, then you can grow another 10%
Yeah.
year on year, right?
Yeah. So in the next slide, I'll show you their cash and their capex plans. So as you can see, in the first half of 2025, they had a capex of 8 million, and then their cash is 5.7 billion.
Oh, the cash is so big
Right.
versus the capex.
And their debt is only 140 million. So they could pay this off if they wanted to.
Why haven't they?
It's
Like here, 2013, they
no, and
paid
the
off
interesting
their
thing
debt.
about their debt, it's really just used to increase their equity stake in their investments, not necessarily to.
Wait, you need debt to increase your equity?
You don't need that, but that's what they use it for.
Because if they have all this cash, how come why not stay debt free? It's weird, no?
That's interesting.
Yeah.
But they still use. So I checked. So their debt levels are minimum, and they use that 140 or whatever they got recently for per nod Ricard investments. That's the one that owns the Alfonso Brandy.
Yeah.
That makes it. That's where they invest most of that money.
Okay.
So they're just increasing their their investment and working capital. So that leads to a very conservative approach for their debt.
Yeah. But yeah, this is really good. Seeing that cash is always increasing, so really free cash flow positive.
Yeah. So and they, if they want, they could really give a lot of dividends.
Yeah, they can hike the dividends. They can reinvest back to the business or acquire other brands, right?
Yeah, so
there's a lot of flexibility.
So management is still looking out for other brands to acquire. So they recently they acquired Servia Global Trading, the one behind Sula, for 40 million. But that has done so far little to uplift revenue. It's not going to contribute a lot yet in 2026.
How about next year?
Next year, it also not a lot. It will slowly increase, but obviously it's not enough to like drastically increase earnings because Sula is a small brand and it's a local brand. It's not really well known yet.
So they have to market it.
Probably, but what they're saying is all their future capex expense and acquisitions are all going to be internally funded. So they're not going to go for debt to increase to do acquisitions.
So you don't project any increase in
No,
debt.
I don't think they're going to have any huge increases in debt.
Okay, that's good.
But expect cash to start to decline after in 2026 onwards because they will start to expand with the stores and look for more brand acquisitions.
Yeah, it's okay. They have a war chest of cash now.
That's huge, right?
Yeah.
It's really huge. But my only concern is liquidity. Because no, like trading volume.
Trading volume.
Yeah,
not cash liquidity.
Not cash liquidity. Sorry, because in the next slide, I'll be talking about the technicals, right? Oh wait,
not this.
Sorry, valuations. So before I go to the technicals, I do have a buy below price of 258 because my target is 310. So this offers you a good risk to reward ratio. Right now, I think it's trading below the buy below price.
Yeah, right now.
Yeah. So value. So right now, KEEPR is trading at cheaper valuations than historical averages. PE is at 7.6 times. Price to book is 1.5 times compared to its historical average about 2 times its book value. To sales, it's also below its a historical average of about 2 times as well. So it's not a huge discount, but it is cheap compared to its historicals.
Yep.
And then so far, its dividend payout, I just put it at 49% because they did say 50, but then if you compute it, it's about 49.8%.
Okay.
So I just put it for 2025 with 49 and basically 49%, which still yields you about 5.75% into 2026.
Yeah. So not bad.
Very,
plus, it's a pair stock.
It's a pair of stock, so you can invest in KEEPR. Okay, technicals. This is what I want to talk about most. So right now, obviously, KEEPR has been in a downtrend, a recent downtrend. Hasn't been doing a lot greatly recently, but so far it has established support around 220. So you see those huge wicks. I'm thinking that is an indication that there are buyers trying to keep it, trying to support the price at that level.
At around the 220 level.
So price keeps getting rejected at those levels, which is a good indication that support might be established here.
Yeah.
So far, it still has to break the down descending trend line.
Yeah, this one.
Exactly, yeah. So one of the reasons why I think this happened is because lower GDP, right?
Yeah.
With lower GDP, growth outlook is slowing down. Consumer spending will likely take a hit because of that also. So it's hard for something greatly correlated to GDP growth or dependent on economic activity and consumer spending. But if the BSP starts cutting rates and we have the corruption issue finds its ending, I think GDP can start to pick up again, and that will start to carry consumer stocks like KEEPR.
As well as the banks, like what
and
I
the
said
banks,
earlier, for loan growth.
Yeah, so right now it's trading within a range between 220 and 240. I think it needs to break above the 50-day, which is about above 240 for it to indicate a trend reversal.
Yeah, but even at current prices, you can just slowly accumulate.
You can slowly accumulate now at the current range because it's easy to cut. If it breaks below, I think
220?
No, not 220, but the lowest wick there, the low of that wick, then you cut.
Yeah. Or if you want really deep cut below 220.
Yeah. So yeah, that is my coverage on Keeper.
Yeah, I think that's our last slide.
That is, yeah. So not so this topic is more informationally heavy
Yeah.
than our previous episodes because we're talking about our research. We just wanted to talk about it because we think it's timely,
Yes.
especially with Para. So we wanted to give you guys some tradable opportunities here
Yeah. Within para stocks, right?
within Para stocks
So you already have 2 picks, right? Keeper and,
and
China
CBC.
Bank.
Yeah,
Right?
and both are actionable.
Yeah, right
Keepers,
now.
I think, more actionable.
Yeah, both are actionable right now. So
Yeah.
yeah, if you have your pair account, maybe the
Watch it.
smallest lot size. Buy na.
Yeah. All right. So that ends our episode for today. Thank you for listening. I hope this keeps you in the long game. We'll see you in the next one. Bye, everyone.